Check, please.
Welcome to Everything Money. In this video, we're going to show you multiple different ETFs and why investing in them can play out really great for your future and your financial savings, your retirement, all of that. We're going to show you 4 or 5 different ETFs, how they perform and their fees. We'll also show you our real estate calculator so you can use these numbers and calculate what you need to retire and what you'll need to live beyond retirement. We're going to get into this right now. Stay tuned about these ETFs. Paul, take it away. What do you think about these?
So the most common comment we get from people is, I don't know where to start. Great. It makes perfect sense. The thing you guys got to remember about saving and about the stock market, I always show this graph.
I love it.
This is the stock market's value over time. This is what the stock market does. Okay, I know people recently probably don't even believe there's a thing called a downtime, but there is. Your goal, if you look at this, is how do I buy all the time over here, right? Well, here's the problem, guys.
Yeah, right.
This is very difficult to do. Why? Because this is the time when everything looks the worst.
Yes.
If you go look at the history of the stock market, go look at the graph, go select the low points. Literally, if you go find articles at those low points, nothing can go well in the world. The world's coming to an end. Stocks are terrible. And as much as you like to think you'd be different, you wouldn't be different. You would think the same things. So you wouldn't put money in. But there is a way around this. Most people actively manage funds, like mutual funds and like your own personal money, don't do as well as the stock market. But you can get away with it because if you save every single year for 40 years, your financial planner can lose the market, but still make you 4 times your money. And you say, look, well, it should have been 10 times, 15 times your money. But 4 or 5 times, that sounds great. They did great for me. But in actuality, it's only 4 or 5%. Because what people do is they buy a ton here, then they get scared and sell everything here, and then finally get excited again and start buying again here.
That's what I do.
Right? Well, that's what most people do. That's what most people do. When I say most people, I mean 99.999% of the population. There are very few people who can't do that. So what's the solution? Very simple. Buy everything. Month in, month out, pick an amount of money you're going to buy no matter what the market's doing. And over long periods of time, you've bought high, you've bought low, but on average, this is what you've paid.
This is dollar cost averaging or DCA.
Yes. It's very simple, guys. You got to take yourself out of the situation and say, I have a plan. And that plan is to save X amount of dollars every single month. And every year I increase it by a little bit. And when I retire at 65, and I started at 25, or whatever age you are today, even 45, I'm going to have a lot more money.
Why should the viewer do this themselves as opposed to investing with a financial advisor who's going to put it in maybe a mutual fund with lots of fees?
Well, first off, they're going to kill you on fees. And we'll show you how that changes your return here shortly with our exclusive Everything Money software. But more importantly, your financial advisor is not smart. They don't understand investing. They're just as emotional as you. They have a thing called career risk. They have to match them. They have to get as close to the market as possible, but they don't really do that. History has shown that 82% of actively managed funds do not beat the market every year. So to find an actively managed fund that beats the market over a 10 or 15 year period is nearly impossible. And the ones that do beat the market are using the bottom 10% at a few years of a 10 or 15 year period. And I guarantee you'd be the person who sells going, wait, this fund made 5%, the market goes up 30%, I'm selling. But that's what you need to be able to do, is be able to stick with a good process. But most people can't do that. Now, the fees. Let's talk about the fees. So guys, this is our Everything Money software. If you've watched any of our videos, you see it, and you can find out more about it soon. It's only $1 a day. It's pretty cheap. This is retirement calculator. This has been a game changer. And the reason this thing is better than all your retirement calculators is this doesn't stop at retirement. Most people sit there and go, oh, my calculator says I'm have $3 million at retirement. Okay, is that enough for you to live? Oh, I'll live at about $3 million. Well, 40 years from now, $3 million isn't $3 million. It's more like $750,000. Can you live off $750,000 for the next 35 years? Well, no, exactly. It factors in inflation. It factors in how long you're going to live. It factors in increases in your spending. So let's start with this. Let's say you are 30 years old.
Yep, I love that.
And you're going to retire at 65. Let's say you currently have 100,000. No, call it 50,000 in savings.
I was going to say that's more normal.
And you're going to save 10,000 per year.
Okay.
You're going to increase your savings by 3.5% a year. So every single year, the first year you save 10,000, next year 10,350, the next year 10,700 and some, and it's going to go up and up and up. And every year you're going to match the market. The market has done 9.9% a year over the last 140, 150 years. Let's just assume 9.9%. And during retirement, you're going to get 6% return because you're going to be more conservative. And you expect to live to 100. And let's say inflation is 3.5% a year. Now you're going to say, Paul, inflation was 7% last year. I know. But over the last 100 and some years, inflation's been 3.5%. So I'm just going to stick with that number. And let's say you currently make $75,000 a year.
Okay.
And you want to live off of the same amount of money, inflation adjusted in the future. Okay? Not less money, which most people will tell you in retirement you're going to spend less. But let's just say the same amount of money. Generate. Do you have enough money to retire? No. You need to save about $559 more per year. So you're pretty close.
Okay.
So at retirement, you will have $5.6 million off of saving $10,000 a year and increasing at 3.5% a year and having an initial $50,000. And when you die, you're going to be broke, unfortunately.
Yes.
But if you change it to, let's change it to $11,000 a year, guess what? You have enough. Now you're left with $1.4 million. So guys, look at that. Increasing it by $1,000 a year took you from a loss of, what was the loss before? The loss was 1.8 million, and now it's a gain.
That much of a difference.
Yep. Now it's a it's a $3.1 million difference by saving $1,000 extra per year. Oh. That's what time does over 70 years.
I see.
70 years is a long time. In the book, Psychology of Money, Morgan Housel says the most important thing about investing is one thing, more important than returns, how early you start. Okay. Now, let's say you go to your financial planner locally. The guy says, oh, I'm a financial genius. Spoiler alert, he's an idiot. And if you don't think he's an idiot, please have him on our show. Have him come sit here, and I will ask him financial questions, and I will absolutely butcher him.
Yeah, that would just be embarrassing. It would be over.
Yes.
I mean, he could never
he would probably sue me, say, do not put this out.
I would agree.
Yes.
Yeah. Okay.
So
talk about those returns, Paul.
Let's say they charge you a measly 1% a year. Don't forget, the mutual fund company is also charging fees around 1% a year as well. So the financial planner charges you 1%, mutual fund charges you 1%. Let's say you get lucky and you get a discount on both and you lose 1.5% a year. So your 9.9% return gets reduced by 1.5. It goes to 8.4%. You're saving. Now, remember here, you're ending with 1.4 at the age of 100. Let's look at the difference now. Minus $12.5 million. You don't have enough to survive.
Talk about what you have at 65.
The funny part is, at 65, look how much you have. 4.2. You're like, look, this is incredible. 4.2 million. But all this time, you're paying fee after fee after fee. And when you're making 6% return, guess what? They're still charging those same fees. They're still charging those same fees. That's the difference of money. Now you have to save $16,400 a year versus $11,000 a year to make up for that. You are handing your financial planner millions and millions of dollars.
No way.
So low-cost ETF, no mutual fund fees, no financial planner fees, just buy every single month, day in and day out, will lead you to millions and millions of dollars extra. I have friends who are financial planners. I like them. They're good people, but they don't realize what these fees cost their clients. So whenever I hear financial planners say, I look at the client first, I'm like, well, then start charging them fees. Put them in low-cost ETFs and stop charging them fees. But you go to them for psychological. The question I have to ask you is it worth millions and millions of dollars? Come to your Uncle Paul. Come to the channel. When things are bad, I'll be here holding you.
Coddling and fondling me.
It'll be okay, son. It'll be okay, daughter.
Hey guys, Seth here, jumping in real quick. We'll get right back to the video, but I want to let you know you can join our software. You can get access to this financial data and the new Everything Money chat right in your phone. Paul will tell you how to get it right now.
So guys, we created the software because our users wanted to be able to analyze their own stocks without having to wait for us. So we put hundreds of thousands of dollars, made the software. You get 30 years of financial data. You get access to Seth, Mo, and I, 8-pillar analysis, the stock analyzer tool, the retirement calculator, and you get everything on this main page that is coming soon. This is all included. And if you look right here, these are all the things you get. You get everything on a mobile phone. Everything we're talking about here is ready, available on your mobile app. One app for everything. But most importantly, guys, you get our Discord, our community of, now it's off of Discord. It's right in our app. You get a community of over 6,000 people you can talk to every single day about your investment ideas. If you're like them, you felt alone having these ideas about investing that weren't reciprocated by others, but now you found the community here. And this is all available for only $1 per day. Less than a cup of coffee. If this can make you 1 or 2% or save you 1 or 2% of losses every year, it will lead to hundreds of thousands, if not millions. $1 per day, 2 ways to sign up. Everythingmoney.com or Patreon. The benefit of everythingmoney.com is we're not large enough yet to charge sales tax, so you won't be charged sales tax quite yet. And look at this, guys. You get all of this. Our competitors are a lot more money and don't provide as much. $1 per day. Go sign up
the
now.
ETFs that I sent over to you. These are the top 4 that we really liked. We'll show you why they're different. Now, this is SPY. This is VOO, the Vanguard Fund. This is IVV, Paul. And this spicy one you're going to like, actually, it's SPLG, which is the little cousin of the SPY ETFs. Folks, you can literally go on Fidelity.com, Vanguard, CharlesSchwab.com, you can sign up for your Roth IRA in a matter of 5 minutes, and then you link your bank account and go buy SPY, and now you're an investor. You've done it yourself. VOO, it's that simple. You do this every month for the rest of your life, and you'll be a gazillionaire like your Uncle Paul. Tell them why, Paul.
So VOO, let's just go to this max chart. It started in 2010. It just matches the S&P. And look at your expense ratio, 0.03. So the typical mutual fund with $1,000 you give them, they're going to charge you roughly, call it $10 to $15 a year. This one, to match the S&P, so to outperform the mutual fund, because 82% of mutual funds do not beat the markets, to outperform that same $1,000 is going to charge you 30 cents. Is that correct? 1% is $10. 3% of 1%, yeah, 30 cents. This adds up to millions of dollars over time.
Wow.
Millions of dollars over time.
Now, if we go over to SPY, you're going to see a very similar chart, a very similar fee structure. So how do those differ, Paul?
Same thing, just different company.
There, yeah.
Its difference is expense ratio is 0.09, so they'd probably advertise VOO would probably be like, we're 1/3 the cost. It's pennies. It's 3 cents a year versus 9 cents a year on every $1,000. It's just a matter of preference. Which one do you want?
So to get hemmed up between the two is really not that big of a deal.
Yeah, it's not a big deal.
How about IVV? This is one of the other nice performing ETFs. I would imagine you're going to say the similar thing.
What's this one? Oh, same thing.
Mm-hmm.
Expense ratio 0.03. All right, same thing, guys. It's potato, whichever one you feel most comfortable with.
Now the only caveat to SPLG, Paul, is that it's far less than SPY. And so explain this thought process about the actual stock price. SPLG is a little cousin to the SPY. SPLG's trading volume is substantially lower, offering somewhat lower liquidity, and its AUM are a sliver of SPM's total. So for buy and hold investors, this shouldn't be a concern. So it's kind of the same thing. It just costs a little less.
I guess. I mean, if you want more liquidity, then go with the. We're talking about literally
pennies,
60 cents to every $1,000 every year, and at this point, pennies don't matter.
Mm-hmm.
And your money manager will be like, "Oh, come on, it's only 1% a year. It's nothing." Yeah, when over 40, 50 years, it adds up big time, big. Because you're not going to all of a sudden fire your money manager after you retire, are you?
How about an ETF they should most likely avoid, Paul?
So, guys, there's a girl I'm dating. Her name is Cathie Wood.
A woman, Paul. You know that.
Woman. Cathie Wood is what I would describe to be, like Jim Cramer, a moron. So Jim Cramer and Cathie Wood are not smart. They don't invest properly. Jim Cramer is a trader. Cathie Wood is a speculator. I don't know what to say. Jim Cramer did a great job having a fund, but he was a trader. He wasn't an investor. An investor looks long-term. He said Cathie Wood was a genius a year ago. Now he says she's not very good. That is not what an investor does. An investor looks at it and says, hey, I said she was a moron from day one, right? The joke I made in one of the previous videos was, don't worry, Cathie, I've always had your back. I've always thought you were very stupid. And that's a fact. So I've always thought she was stupid. So this was investing in high-growth disruption companies. In the last year, it's down over 50%. It hit a high of $159, and now it's $73. According to her, she touted this before. Look, I'm a genius.
Yeah.
Now she's like, oh, it's value. No, according to your theory, if you're a genius here, you're stupid here. Guys, these are highly speculative stocks. We once looked at it. I don't know if it's still the case. The top 20 holdings, only 17 were profitable companies. If you buy into that, you buy into that. Great, congratulations. Just think that's stupid.
Yeah, a lot of people lost a lot of money on this ETF, and so this is not would be one of those what we would consider like a safe, disciplined investment.
Not a single dividend. She's like, well, they're all growing companies, and look at this expense ratio.
Oddly enough, yeah, I was going to say the expense ratio is multiples time more.
So she's collecting $130 million, 75% of that. Call it $100 million in fees. You're telling me it costs $100 million for her to manage money that way? I could do it for $4.
Yeah, buy ETFs.
Ready? Oh, not even that. Is the company up a lot? Yes. Okay, buy it. And just say it's disruptive. That's what I'll do.
I see.
Let's look at our top holdings. Tesla, Zoom, Teladoc, Roku, Coinbase, Exact Sciences, Unity Software, Spotify, UiPath, blah, 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 blah. Go look at all these companies. Pause this. Look at all the companies for the last year. Oh, Palantir, look at this.
Oh, nice.
Cute. Now let's look at S&P 500. Top holdings: Apple, Microsoft, Amazon, Google, Tesla, another Google, Facebook, Nvidia, Berkshire Hathaway, United Group, JP Morgan, Johnson & Johnson, Home Depot, Procter & Gamble. Yes, these are boring companies. Spoiler alert, Warren Buffett made 21% a year over the last 60 years investing in boring companies because everybody thought they were boring, so he bought them cheap and made a ton of money. You decide if you want to be Cathie Wood, who will probably not even be in the business in 10 years, not even from a forced retirement, versus Warren Buffett. You pick.
Yeah, the decision was simple for me, Paul. I mean, I really like this. So if you're drawn to this, if you're drawn to looking at actual numbers and not just watching people spout off their gains, or if you're confused out there, you can join our community, get our software. Go to everythingmoney.com or patreon.com/everythingmoney. You can join our community of over 6,000 investors from all over the world. If you have questions, you have access to Paul and I. We give you exclusive videos. You get all the tools that we showed you in this video, and we have 1,300 other videos before this where you can develop this lingo and this new language to become an investor yourself and manage your own finances moving forward. It's a fun path to get on, and we invite you into our channel to help you along. So that's our take on ETFs. Stay tuned. These are not going to change drastically, and that's the whole point. This whole channel, Paul and I and Mo and Tim here, is get rich. Let's get rich slow, and we'll guide you all the way. So see you next video. Thanks.